All right, we'll call to order the pension committee meeting for Murfreesboro MED pension plan. What is it, August the 11th, 10 a.m.? Well, let's start, Melissa, if you could start with our prayer, and then we'll do our pledge.
Please join me. Dear Heavenly Father, thank you so much for this day. Thank you for the opportunity for us to come together and serve our citizens and our employees. Please help us make good decisions when we deliberate. Please bless our city, bless those who serve, give them the strength and confidence to do their jobs, give those protection that are out in dangerous situations. Thank you for all you do for us. In Jesus' name I pray. Amen.
Amen.
I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Okay. First, we have consideration of the minutes of April 28th, 2022.
Make a motion to approve.
A second.
Good. All in favor?
Aye.
All right. Next, Ms. Holland, the review of investment performance and account status from January through July 2022.
Good morning.
How are you doing, Tammy?
I'm doing fine, thank you.
Good.
I know that you had an electronic copy, and we've provided you with a hard copy. If we've missed somebody, just let me know. We've kept the format pretty much the same, and as you mentioned, we've taken a look year-to-date through June, and then behind tab 1, we've also taken a snapshot of July as well. If you look at page 3, this is the summary that you guys should be fairly familiar with when you look at the statement. So we've captured the last 6 months in the left column, January through June, and then the trailing 1 year in the right column. So if we look at the last 6 months, the cost basis we started with was $25,249,215. I know it's unusual to see a receipt in there. That was a refund for overpayment from a consultant, that little $4,200 that you're seeing there. We collected $267,000 roughly in dividend and interest from the investments that we own. We had some accrued income. We made benefit payments in the amount of just over $820,000. The cost or expense was $66,423. We took, through the activity in the portfolio, realized gains of $180,855. We had an unrealized gain of $1,003,000, and the total market value as of the end of June was $26,156,635. If you look at the July column, our cost started with $25,457,000. That same refund for that overpayment from the consultant is captured there. Our dividends and interest are a little over $900,000. We had some accrued income there. We paid benefits to the tune of just shy of $1.7 million. The expense was $137,962. Realized gains of $243,698, and then an unrealized gain of $1,344,000 for ending at that same total market value for that June 30 of $26,156,635. $26,156,635. You can see at that bottom column the beginning market value for both the 6-month and the 1-year time period versus the ending market value. So clearly the market has been a challenge for the first 6 months of the year, a significant challenge, and pretty much starting in the last quarter of last year. July was a better month. We're seeing some positives in the market right now, so this number has changed considerably since June month end to July month end, and then where we are again right now. Some people think, is that a bear market bounce? Are we going to see, retest some of those lows? Will there be continued volatility? I think the answer to that question is yes, there will be continued volatility. People are afraid of the Fed. There are a lot of things that are, impacting the market right now. Earnings season is just about done. I think really the consumer discretionary sector of the market still has to report earnings, but for the most part, the rest of the other companies have reported, and I guess the kind of consensus is it wasn't as bad as they thought. So it might not have been great, but it was better than expectation for most of the companies reporting their earnings. So there's still a lot of really healthy companies with really strong balance sheets, a lot of cash to put to work. We're trying to see what's going to happen as far as inflation, what the Fed does. Is there going to be a resolution, Russia, Ukraine? So there's a lot of noise out there that's impacting the market. So I think volatility will persist and probably push into 2023. If you flip over one page, you'll see a snapshot as of June 30. And this is just really from a high level. We had about $714,000 in the money market position. Of course, that's where we pay the benefits. That's also where we collect the dividends and interest from the investments that we own. One thing to note is, as interest rates have climbed, the yield on the money market has climbed significantly as well. So the yield on the money market now is probably pushing 1.5. I know that doesn't sound exciting, but it's certainly better than 0.25. So we've seen that yield climb pretty significantly. We're just shy of 60% on the equities or the stocks that we have in the portfolio at the end of June, and then right around 40% in fixed income. And we kind of live in that, give or take 60-40 allocation. One of the differences, and we might have talked about this a little bit last time I was here, is we've utilized U.S. government securities, treasuries, some agencies. Over the last couple months, we've seen that we're able to pick up some nice yield on the very short end, so we've utilized that in anticipation of maybe some higher rates later, so not making long commitments with some of those dollars. I think most of us know that the yield curve from 0 to 2 years goes pretty much straight up. You're really incented on that very short end, and then it turns downwards and it's inverted, so at 10 years you're earning less than you are pretty much at 2 years. So we've tried to kind of capitalize on that short end in anticipation of rates coming a little higher later. If we are able to get a nice rate, let's say we get 4%, I know that doesn't sound like a big number, but for me that's a big number in the 2 or 3 year space. We'll take stock of that and we'll go ahead and make that commitment. One of the other things on the bond side of the portfolio that we probably haven't done in a long time is because rates have climbed. If we replaced or added any bonds to the portfolio in the last year or 18 months, those coupons are probably pretty low. So we're looking for opportunities as rates climb to maybe switch from those holdings into locking in a higher rate. So there might be a little more activity on the fixed income side than you've seen in the past. So this is really just a snapshot. You guys have seen this in your statement. As of the end of June, we had about $750,000 on the bond side of things that was going to come due for us. So that's always a place that we can find liquidity to go ahead and make those payments. So we're not forced to sell something in a bad market or on a bad day in the market. So the next several pages, and the page numbers in the upper right-hand corner, 2 through I think 8 or 9, actually it might be 10, is a look at all of the holdings. Really the only changes, we changed out a small cap manager. So we used to own a manager named Crawford. We now own one called World Applied Finance. It's a small cap manager. They're new to the portfolio, so you'll see that position in the portfolio this year. And we made a couple small equity changes, so there's a couple new names in the portfolio there as well. If you flip past the holdings to page 13 in the bottom center of the page, this will tell us performance. This is the fun part right now. This is the total account performance, so the account as a whole, and we're capturing year-to-date, 1 year, 3, and 5. And you can see through June, the entire account as a whole was down 16%. For the 1 year trailing, the July 1st through June 30, it's down around 1270. The 3 year average is around 332, and the 5 year is around 412. So when we look at like the underlying assumptions long-term for the plan, obviously the last 6 months is really significantly, it can really impact not only a year-to-date 1 year, but a 3 and 5 year trailing number. I think when you look at the July performance that I've provided in here, you can see how quickly 1 month of good performance can move that needle a little bit. But it's really been, there's been no place to hide. Large companies, small companies, international companies, bonds, everywhere you look, we've seen a negative return so far this year. If you flip over one page, this talks a little bit about the fixed income in the portfolio, and I think the most important thing to look at here, the middle column is June 30th of 2021, and if you come down and you see that yield to maturity of 1.06, and then you move to the left to the June 30, you'll see that yield to maturity is 378. So in a year, we've seen interest rates triple what we were able to provide and put in the portfolio. So as interest rates rise, the value of your bonds go down, you see a negative performance on the fixed income, but we are able to capture higher coupons in the portfolio. So that's really, I think, the most distinguishing factor here. The other part is the duration or the length of the bonds that we hold in the portfolio. It really hasn't changed that much. It's pretty short. It's 3.25, 3.5 years. So if rates come up a little bit and we like them a little bit better, you might see that duration extend out and we might make commitments a little bit longer. The next page, which is page 15, is the performance for the bonds in the portfolio. And as I mentioned, you really couldn't hide. Usually you think, well, if my stocks are going down, maybe my bonds will give me a little bit of support. Year to date, the bonds in the portfolio are down 5.25 versus the benchmark of about 7.5. The 1 year, still in that neighborhood, 5.78 versus your benchmark at just shy of 8. Then a 3-year annualized number of 30 basis points or 0.3%, and then a 5-year of 1.42. So we've done a really good job managing duration and quality in the portfolio versus our benchmark. It's just as interest rates rise, your bonds aren't as attractive and they've suffered in addition to the equity side of things. The next page just looks at really what do we have in domestic or U.S. stocks versus international. So we typically have obviously the bulk in U.S. for large, small, intermediate, or mid-cap. We've got about 83% there and about 17% in international. And we always have the vast majority of the assets on the domestic side in large cap versus mid and small. So if you flip over page 17 in the bottom center, you'll see the equity performance in the portfolio, and then we've included the performance for the S&P 500 and the MSCI EAFE, which is an international benchmark. So year to date through June, the equities in the portfolio are off about 22%. You can see the S&P and the international are about 20, 19.5, give or take. If you move left, the 1 year is off 16.7, and S&P down 10.6, the international off 17, almost 18. We move into the 3-year of a 649 annualized return, and then a 5-year of 7, which I think is a little shy based on kind of your long-term assumptions with where the market is. And you can see kind of the difference or the distinction between the S&P 500 and that international benchmark. So clearly, domestic, large cap type names have outperformed international type names. The individual large cap stocks in this particular portfolio have a little bit of a growth bias to them. So the shift probably last quarter of last year has been more of a value type bias, a stock that pays a dividend. So think Apple, Microsoft, Amazon, Google. Those are all core holdings in the portfolio that had done tremendous for years, but the first 6 months of this year have kind of sold off a bit. We've trimmed those over the years. We continue to have a weighting. We still like those long term, but there is a little bit more of a growth bias in this portfolio. On the next page, it's just a snapshot of the transactions in the portfolio. If anyone's curious what we've done throughout, I think this is the beginning of the year through June 30, so activity. As I mentioned, we swapped out small cap manager. We've added some new bonds. There's a treasury bill there, some corporate debt. And then we added 2 technology names that are more cloud-based, kind of not old school technology looking forward. That hasn't really worked out yet. We've only owned them several months this year, so we look for them going into next year to really add value. And then we added Alcoa to the portfolio earlier this year. The next page I think I've provided for you. This is kind of a snapshot of the individual stocks that we own in the portfolio. So we own all of the individual names. This is just a summary for you. It gives you a little historical perspective on what the performance has been and the types of names that we own. If you look behind tab 1, you'll see July 31st. So as I mentioned, on June 30th, our market value was $26,156,635. You'll see at the end of July, we'd picked up $1.3 million in market value, predominantly on the equity side of things. And then this morning, we've picked up another couple $100,000, the first 10 days of August. So July and August have been favorable to the market value. But at the end of July, we had about 1.5% in that money market position, about 60% again in equities, and then 38% in fixed income. And we're looking at about 550 or 600,000 that will mature through now and the end of the year that's available for distributions, reinvestment, wherever we feel like we need to look to meet that distribution need. The key for us is to continuously have that cash rolling off, because we don't want to have to sell anything on the equity side of things when the market is not performing favorably. So again, a list of all the holdings, which you've probably seen in your statement, but you'll notice on page 3 in the upper right-hand corner, we have one certificate of deposit. We've got a fair amount of agency securities. Where it says municipal obligations, those are taxable municipals, so they're taxable, not tax-free. And then the majority is in corporate bonds or corporate debt. And then again, a whole list of the holdings. Really the larger individual positions would be, I would say, Apple, Microsoft, Amazon. And when I say large, they don't represent 2% of the entire portfolio when you put those bonds in the portfolio. And then I've provided, if you move past the holdings, it says page 29 in the bottom center. So our July performance just came in Monday. So year-to-date through July, still a negative number, but we've picked up about 600 basis points or 6%, down 11. The one-year trailing is down 8 3/4. The 3-year annualized is a little over 5, and the 5-year annualized is right around 5. So as a whole, I would say, we picked up, we made distributions in that month, and after those distributions, we picked up, $1.5 million market value-wise with better performance in the market. So the market's strong again today. There's been some news the last couple of days that it has been favorable, or what people perceive as favorable. Things don't seem as hot or as poor as they thought they were, so those numbers are a little more favorable. So the market has traded up, I think, 4 of the last 5 days, and probably 80% of the names in the S&P 500 have finally crossed over their 50-day moving average, but I think there will continue to be some volatility in the market. I think we are not, kind of out of the woods and on a steady incline back to where we are. So for us, it's trying to add names to the portfolio if we feel like we need to be a little more defensive or have better growth prospects coming out. So we have done that. We're getting ready to switch out. There's an Oppenheimer. They're an international manager that's in the portfolio. We'll probably swap that out within the next 2 or 3 days. We've done a fair amount of research on it in the last 2 months, and we feel like we've found a better alternative as far as who we want to use in that space. It's more of the emerging market space, so it's a much smaller holdings in the portfolio, but you'll probably see that swap, I would say, Monday. So that's something that we're doing in the portfolio going forward. I know I roll through that like I always do. So please, if anyone has any questions.
Any questions?
No.
Well, thank you.
Thank you, Tammy.
Yeah, we appreciate your time.
Did it.
You guys have a good day.
Thank you. Mr. Wilkerson, give us the results of the lump sum survey from USI Consulting Group.
Good morning, committee members. You should have in front of you a copy of the document. It's a letter was sent to us, or to me directly from USI, dated July the 18th. What it is a summary of the lump sum interest survey that was sent to all the deferred vested participants. There's 45 participants. You'll see in the document there was 29 individuals who were interested in the lump sum, which represent really 64% of people who are interested. Non-interested was 3. Unsure was 1. No response was 12. So the result shows that there are many individuals who are interested in the survey. Any questions, concerns, or comments I can address?
I think generally it's a pretty good response.
Yes.
And as far as the numbers, I know we had 12 that didn't respond, but I think that's somewhat expected, that people just didn't know or didn't get back to us in a timely manner. But
Correct.
the interested, it's a pretty substantial number of people that at least express an interest in doing it. So,
Correct.
Appreciate that.
All right.
Any questions? Okay. Thank you, Randolph. Ms. Tucker?
Thank you. Yeah, we have a plan amendment for the MED pension. The Secure Act of 2019 requires that plan documents be amended by the end of this year to reflect increased required minimum distribution age from 70 and a half to 72 for participants born after June 30th of 1949. The Act also requires that we update the language about the actuarial tables to reflect the specific regulations as listed in the plan amendment. I would be happy to answer these any questions, but it's a lot of actuarial table information and all of that. I just know that the IRS is requiring these changes, so.
So we'll take a motion on something we have no choice on.
Motion to approve.
I'll second.
All right. All in favor?
Aye.
All right. Aye. That'll pass. Thank you, Aaron.
Thank you.
Keep going then into staff recommendations. We have a couple of contracts related to potential transfer of the pension from the city to an annuity company.
Yes, so as part of the sale of the electric department, Middle Tennessee Electric is obligated to contribute up to $3.5 million or 50% of the cost to fund the transfer and termination of the MED defined benefit plan, as long as that occurs within 3 years of the sale. So just to be clear, we're talking about a plan termination after annuities have been placed and after lump sum distributions, not terminating any participants or any benefits to the participants. At the last meeting, y'all approved that contract for USI to survey the participants, and as Mr. Wilkerson just conveyed, the results indicate that the majority are interested in at least exploring the option of a lump sum. So the city received proposals from 3 firms for lump sum distribution, plan termination, and annuity placement services. Staff recommends that we contract with Cowden and Associates for the lump sum distribution and plan termination services. And on that contract, there were several options. So we would suggest electing option C, which provides a wide range of services to the city. As you may recall, Cowden and Associates performed the review of the MED defined benefit plan when we sold the electric department, and they did recalculations of the benefits and assisted the city with amendment language for the plan. So they have a strong familiarity with our plan document and what's in it. We do have Amy Krause with Cowden on the line. If y'all have any questions for her specific to the lump sum distributions and their services with that, or with the plan termination after the lump sums and annuity placements have been done.
So Aaron or
Amy.
If somebody could explain, when we talk about the lump sums with the individuals, what the plan is as far as assisting them on making the choice.
Amy, did you hear that question? Could you help answer that?
Sure. So as far as assisting the participants, it's really a matter of educating them so that they understand what their options are. So, for example, with the lump sum, if they don't elect a lump sum payment, so an immediate distribution currently, then when the plan goes terminate, that feature, that lump sum distribution, is not going to be a future option for them. And I think we'll talk more later in the meeting about the annuity purchase process. But so really it's a matter of answering questions for the participants, making sure they understand tax implications of it, and just providing them as much information we can so that they can make an informed decision based on their circumstances.
So be available for one-on-one meetings with the participants to help them through it.
And who would conduct those meetings?
That would be,
I would assume Employee Services would work directly with Cowden and Associates to reach out to the participants to see if they would like to meet with Cowden and set that whole process up.
Excellent.
We had a lot of, well, I'm still working there, so I had a lot of questions from employees on how this calculates. And I couldn't tell them. I really couldn't feel comfortable about telling them. I had an idea, but I couldn't tell them. And our employees, you know, they don't mean this bad, but they're probably the highest educated group in the city, just because, you know, we pay well and draw better, you know, crop there. But anyhow, if you shortchange them 3 hours on overtime, they're knocking on your door the next day to let you know that there's a problem with their check, and they want to understand this. And from our point of view, mine too, you know, when you have a job with a company, you basically have a contract, and you're giving your life up for the pay and the benefits. And for me especially, and a lot of the others too, the older ones, this is all we got as far as retirement. And we have concerns about how this is calculated and to make sure it's done properly. And, you know, did we try to get out as cheap as we could, or are we doing what the industry standard is, or what the wiggle room is? I know that the IRS has, these are tax exempt, so they have guidelines you have to go by, and I'm sure they've got a minimum that you can do as far as doing a payout on the not taking the annuity, taking the cash option. So they're going to have some questions.
Absolutely, and I think Cowden and Associates is more than equipped to answer those questions and explain in easy to understand terms actuarially how those benefits have been calculated. And so I'm certain that when they sit down with the participants, they'll be able to explain what rate of return was used and all that, and the justification behind that, so that they can feel comfortable with what was calculated. That doesn't mean the participant necessarily wants to elect that lump sum. That's completely up to the participant. So if they decide that that's not an amount that they're looking for, or they don't think that they want to take that on and then reinvest in their 401k or whatever other plans they have, then they'll still have that option to stay in the pension plan, and that would be part of the annuity placement service, which would provide the same distribution and benefit as though the MED pension plan was still in effect.
And then with the annuity, I've had questions concerning, is this stable going with a company like this? Is there guidelines to protect us? Because if the company goes bankrupt,
Right, so we'll
will our
talk.
annuity to go away, or?
No, so the next topic item is about the annuity placement services contract. That's with a separate firm, and we have members from that company on the phone as well who can talk to you about that.
yeah, so this is just regarding the lump sum, right?
Right.
Yes, I got
Right.
I completely understand. Yeah, I just don't want to mix up the two conversations.
So they will be able to set up times where they can meet with this company and discuss it, and they'll explain it totally, and they'll understand exactly how it's calculated.
That's right.
Okay.
Amy, did you have anything to add to what I just said?
No, I think you covered it well.
Yeah. So the survey, and I understand that the feedback was, we don't really know what it is, but the survey is really to gauge the interest, if there was enough.
We understand, but this still
Yeah.
brings on more questions.
Yeah, and it does bring on more questions, and so the next step would be to answer those questions. So that was always the plan, to do that. So I think, communicating back that there was always an expectation on our part that there would be questions, and that we would sit down and talk to individuals about that, so they'd have those answered. So we wouldn't have done it otherwise.
Right, I will just add, part of the services that we're proposing on is having a dedicated, call center phone number that they can call and ask questions, talking to somebody directly. Aaron and I discussed having in-person meetings, setting up something where participants can come in and ask questions in person rather than over the phone. And we've also set up dedicated email address that participants can send information to or send questions to.
And they still have the option of taking the annuity if they don't want the cash option.
Exactly.
Correct. And we'll make sure that's clear in anything that we send out to the participants, that there is an option to decline the lump sum and go to the annuity like the plan currently is set up.
And just to be clear, the lump sum will be offered to the deferred vested, not the active participants that are actively taking benefits currently.
Yeah, and it states that in the
Right.
letter y'all provided.
Okay, any more questions?
If not, I'll make a motion to approve the contract
Okay.
with Cowden.
A second.
Good. All in favor?
Aye.
Aye. Okay, contract's approved. Go forward with that. The next is a contract approval with BCG, and this regards the annuity placement services.
Right, so just as we were just discussing, we recommend engaging with BCG Pension Risk Consultants for the annuity placement services. BCG specializes in annuity placements and has provided more than 2,500 plans with these same services. Now, their process includes following specific U.S. Department of Labor guidelines, which the city, being not a non-ERISA plan, is not subject to. However, it is a best practice, so we definitely want to still continue to follow those guidelines, even though we're not required to do so. And by following those guidelines and that checklist, BCG can determine the most qualified insurance carrier that will provide what's called the safest available annuity, so that our participants can be confident that their benefits are stable and secure. And Mike Devlin and Dan Atkinson from BCG are also on the line if y'all have any specific questions for them.
Any questions?
No.
No? Okay. We have a motion to approve that contract.
Make the motion.
A second.
Okay, all in favor? Aye. Good. Well, thanks to the folks from Cowden and BCG for their time this morning, and appreciate the efforts, and we look forward to working with them as we go forward in the process.
May I ask a question? Will this be funded out of the pension, or is it out of the general fund of the city?
The cost of termination will be funded from the pension plan assets, and then also, half of that, up to $3.5 million, will be shared with Middle Tennessee Electric.
I meant the cost of these companies to help close it out.
Right, that, my understanding is any
That come from the pension.
direct costs associated with that plan termination would fall under that as well.
Because I know I'll be asked that too.
Yeah.
Okay, next, information only. You have in your packet a letter dated June 9th, which is from the state of Tennessee, indicating that we were in compliance with the requirements of the Treasury Department, which is always good news. I like to stay in compliance with the state requirements. Next is an invoice that was a reimbursement of overpayment to USI, our actuarial company, for services they provided. So they contributed back to the pension plan $2,260, which I think was part of that Tammy had mentioned earlier, what came back from consultants in there. So that's part of that $4,000. And then C is a similar reimbursement by the city to the MED pension plan for about $2,000. So if you add those up, I think you get that reimbursement back into the plan. Any questions on those?
No.
Good. All right, any other business? Well, appreciate it. Always good to see everyone here, and appreciate your services. Thank you very much. We'll close the meeting.